All right, what is up, my peeps? Joshua Smith here with another GSD Mode podcast, weekly real estate tip. And today I want to talk to you about 23 reasons as to why this real estate market crash, this economic crash, this recession that we are all experiencing right now could be much worse than you think, could be much worse than we are anticipating, and so forth. So these aren't all of the different things that I'm paying attention to, but these are some major factors, a lot of the major ones that I'm paying attention to to just keep a grip on where the hell this market is going. I know that there's so much talk out there of, and you know, people can be very tribal, you know, on their different viewpoints and so forth of where this is going. And I know that I'm talking about, you know, 23 points as to why this market's going to be uglier than most people think and so forth. And I'm not doing this as as fear porn. I'm not doing this, you know, from a stance of Chicken Little, sky is falling, you know, or clickbait. I'm doing this because I think it's something that we all need to take seriously. I think as real estate professionals, who this channel is for, real estate agents, team leaders, and broker owners, look, we got to be prepared. And my personal philosophy is hope for the best, plan for the worst. If worst case scenario doesn't happen, but I'm prepped and ready to rock and roll, and I prepared for it, then I'm good to go. If worst case scenario does happen, then I am still good to go. However, you know, I'm in conversations. I mean, this is all I do is real estate, right? So I'm in conversations each and every single day with top professionals from all over, plus, you know, with agents on the ground and my agents, you know, and so forth. And there's just so many different mixed things, mixed beliefs. A lot of this is people's beliefs. I believe that a lot of this, what I'm seeing right now, is people burying their head in the sand, not wanting things to, you know, a lot of times we attach to the things that we want to hear consciously or subconsciously, you know, versus the things that maybe that we need to hear and need to be prepared for. And I saw this, you know, you got to understand that I've been doing this almost 18 years now. So I jumped into this business in early 2005, which 2005 was very similar to 2021. And 2020, 2021, not quite as low of inventory in my market, but it was still, you know, extreme seller's market, massively inflated prices, just crazy shit that like we were seeing in the last couple of years. But then as the market started to correct, which is what I'm like in my market right now, when people sit there and say, oh, this isn't going to be 2008, I'm like, well, you know, I'm not saying that it is. However, right now, I'm not comparing the moment that we're in right now to 2008. What I'm comparing this to right now is like, you know, last quarter of 2005 or early 2006. I'm seeing a lot of the same trends, but I can tell you at that time, even into 2006, 2007, the common thing I kept hearing is, oh, the market is going to crash, real estate long-term, you know, like all this shit. Like so many people buried their head in the sand, didn't pay attention to what was actually taking place, didn't actually just even pay attention to data. And that's what I really, and I'm going to go through these 23 points. Then I'm going to show you guys, I'm going to screen share and show you the data that I pay attention to. You know, I don't attach to, I believe in business, you got to be an ideology atheist. I'm not sitting here attaching to, you know, if the market's going to crash or not going to crash. I hope for the best, plan for the worst. So I'm personally planning and preparing for the worst housing crash in recorded history, much worse than it was in 2008. Not saying that's going to happen. I don't have a crystal ball. I'm just prepping and planning for it. Because again, hope for the best, plan for the worst. I'm just preparing and getting ready for what this could look like. Okay, if I know for a fact the real estate market is going to absolutely be obliterated, how can I best prepare myself for that position? You know, and so forth. And then hope to God that doesn't take place. That doesn't happen. Either way, like I said, I'm good to go. But at the end of the day, it doesn't matter, right? And when I mean that, when I'm saying that, please don't take this out of context. I hate seeing people lose their homes and get hurt financially, you know, and so forth. When I say it doesn't matter, what I mean by that is it doesn't need to matter to your real estate business. There's no reason as to why your business can't continue to grow, scale, and thrive, regardless of the actual marketplace itself and what's taking place in the market. You know, and I've been able to continue to grow and expand my business year after year, regardless, whether it's been the biggest boom that our industry's ever seen, like we just got out of, or whether it's the biggest real estate market crash in recorded history, like the great financial crisis, 2008, 2009, 2010, and so forth. And it's because of what I'm going to walk you guys through and how I pay attention to this. Because here's the common denominator. The one consistent is the real estate itself. The real estate itself is always moving. It's always trading hands. Throughout my whole entire career, it's like, okay, here's the geographical locations that I work. So here's the product that I, you know, like the product itself is the real estate and these geographical locations that I specialize in and that I work, right? So that's the product. Well, the product's always been moving. right? The only thing that's differentiated is who's buying it, who's selling it, and what are the reasons that they're buying it and selling it. And throughout my career, that's been traditional buyers, sellers, that's been, move up buyers, downsizers, that's been first time buyers, that's been investors, flippers, that's been institutional investors, that's been REO, foreclosures, bank owned foreclosures, that's been short sales, but the one constant is the real estate itself within the geographical locations that I work. That is the one constant. The only thing that's changed, again, is who's buying it, who's selling it, the reasons that they're buying it and selling it. So you got to understand and be able to know and pay attention to what those trends are and so forth. So I'm going to jump through these 23 different reasons just to, get your wheels turning. And again, to just maybe help you go out there and prepare. These are things that not all of these things, are talked about. And a lot of people just aren't connecting the dots. The common thing that I hear is, oh, it's not going to be as severe because loans are done in a great way in the residential space. Okay, yeah, there's a lot of truth to that, since all the subprime market, all that bullshit that was taking place back in 2005, 2006, and so forth, that has been fixed, that has been corrected. However, there's been a lot of fraudulent, manipulated loans that have been pushed upon the consumer in other markets, which I'll talk about here, as well. As you got to remember, it's just all it comes down to is personal hardships that people are experiencing that can cause them to have to sell their house, have to fire sell their house. And then if things get demand destruction gets big and deep enough, then market prices can drop. And to an extent where, okay, now they might be having to do a short sale, might having to do a foreclosure. And we look at, anybody that bought in 22, and I can only speak to my market. Real estate's very hyper local. I'm here in Phoenix, Arizona, and my market's like anybody that bought in 2021, if they have to sell in the next couple of years, they're going to be fucked. Right? Like they're not going to have equity to go out there and be able to sell their property. They've already lost a lot of equity, a decent chunk of equity in their property versus what they paid for it, especially for those that were, having to, go bid against 50 other offers and do the appraisal gaps and all the crazy stuff that we saw. Okay. So these are the 23 reasons just to, again, get the wheels turning and so forth. So number one, the auto loan collapse. So a lot of fraud, a lot of loose lending that's been taking place over the last few years. And there's a lot of experts in this space that believe that this is going to be like the next potential bank financial meltdown is due and going to be driven to or from the auto industry. Like in 2008, a lot of it was due to the mortgage industry. And there's other reasons that led up to that as well. But a lot of experts that are in the financial loan space, that this is their area of expertise, they believe that this could be a repeat where the banks get themselves in massive troubles, due to the way that they've been doing these fraudulent loans and loaning on cars that are like, 150% financed of actual value. So they're, way underwater with that. So very similar to the subprime mortgage prior to the last market crash. So currently we're at an all-time record highs. And as you see my eyes moving from the camera, it's because I'm reading my notes here. So we're currently at all-time record highs in defaults and repos within the auto loan industry and the subprime loan industry. And then when it comes to lenders that are repoing these, and then they're going to auctions to sell these off. A lot of these lenders aren't actually selling at the auction because the price that they have to sell at. Then from there, if they were to take that and accept that, they have to realize that loss on their balance sheet. And they're not willing to do that because that can potentially put them in a very, very tough position. If you look at the average US car payment on a new vehicle right now, it's $648. So that's a 12.31% increase from 12 months ago. So that's not counting gas, that's not counting insurance, that's not counting maintenance, that's not counting all these other things. All right, number two, commercial real estate, a lot of loan manipulation and fraud, again, similar to the subprime loan crisis in 2008. So a lot of this has been taking place over the last couple of years. A lot of this started taking place during the COVID lockdowns, and so forth. All right, so number three, record high inflation. So, I know that we get told from the government and so forth that, oh, inflation is starting to come down. Which just is not the case. There's some crossflation that we're experiencing where certain things, inflation, yes, is coming down slightly on, but it has to come down so much to be where it was before this insane inflationary time that we've experienced. And if we look at true inflation, I mean, this is the worst inflation that we've really seen since about 1918. If we're calculating based on the same models that they use to calculate inflation by, in the 70s, 80s, during the 87 crash, and so forth. However, Michigan State just came out with some research based on inflation on necessities. So based on, okay, the average household with the necessities, because if you look at CPI inflation, the numbers that were given from, the government, that includes all these different baskets of goods, and some of those just aren't necessities. Like, okay, well, if this cell phone comes out with superior technology, right? So all of a sudden it comes out where it's much faster, better video, has superior technology, but the price itself stays the same. Well, then they're counting that as, so let's just say it's twice as fast, twice as good as far as a technology standpoint. On this, then they're saying that this is half the price, but the price didn't go down to half. There's so much manipulation in that bullshit. But if we look at necessity, so Michigan State came out with this research recently. And when I'm saying necessity, I'm talking about your utilities, talking about energy, food, so gas and natural gas, and to heat your property, and electricity, cleaning products, whether that be personal grooming products or household cleaning products. So the things that we are, like we're not going to go without, that we're buying on a daily, weekly basis, monthly basis, that we, like I don't need the 55-inch new flat screen that might be on a discount because of this whole bullwhip effect where a Target is sitting on an abundance of these, and maybe those are slightly cheaper, which will be reflected in the CPI. I'm talking about things that we actually need. Well, year over year, so we're talking a 30% increase on necessities when it comes to inflation. So when we think about this, because all this, remember, as I said earlier, this all boils down to the hardships that the average people, you and me, and those that live in our communities can be facing. So it's not just, so many people just get so fixated on, well, interest rates were low, their mortgage payment's going to be fixed, they're in a good loan. Well, what about all the other shit? Okay, now they got increased car payments. They got increased, like just day-to-day life continues to get more and more expensive. And from everything that I see, I don't see inflation by any, way possible. And maybe, and I hope to God I'm wrong on all of this. Again, this is just a hope for the best, plan for the worst. But with the due diligence and research that I'm doing, I don't see it being better for the next, 5-10 years. I mean, this is a long-term thing. All right, so record low employment participation rate. We keep hearing about record low employment rates and so forth, but when you look at job participation, we're at record lows, man. Like 59% of those that are classified as working age Americans, if you will, actually are going out there and getting jobs, dude. So we have record low overall employment participation rate. And then if you break down how our unemployment was calculated pre-1990, when the Clinton administration changed how we calculate all these models. So if we look at that for the 87 crash, the 70s and early 80s, the Great Depression and so forth, true unemployment right now is 24.4%. So like we are almost as high as we were during the Great Depression with unemployment. So unemployment is not the pretty picture that we're seeing, and then right now we're starting to see, we've been seeing this for a while with job recensions, job freezes, hiring freezes. Now we're starting to see a lot of job layoffs. This is taking place, and we're in a technical recession now. And usually we start to see a lot of these, job layoffs about this, usually a 4 to 5 month lag from the start of the recession. And that can happen quicker, can happen later, and so forth. But this is, potentially going to continue at high levels. All right, so if you look at and just to give an example of this, so I was just listening to FedEx, a podcast or news thing that FedEx was on, or a representative from FedEx was on, and they're talking about FedEx ground right now. So you have 1/3 of FedEx contractors. So when you get FedEx packages delivered to your door, these are FedEx contractors that go out there and buy their own trucks and that contract directly with FedEx and to go out there and deliver those packages to you. 1/3 of them nationally right now on the verge of collapse due to inflation. They just can't hang on right now. They're getting absolutely crushed. Okay, so number 5, you got 20% or greater of S&P 500 companies. So the 500 largest companies in the United States, over 20% of these can't even afford interest-only payments on their debt. Meaning they're zombie companies. Like they if they are not getting infused capital, by investors, and if they can't raise new rounds of capital and figure this out, boom, they can't make payroll. They can't. So when you look at that, just imagine that. Imagine if 20% of the largest 500 companies in the United States had to get to a point where they became obsolete. I mean, that means they're insolvent already, right? So what does that look like? And how does that exacerbate the recession and the problem that we're in and people's affordability to be able to continue paying for the real estate and so forth? So number 6, stock market still heavily inflated, even though that we've seen some, corrections. NASDAQ, I guess, technically is in a technical crash, meaning beyond 20%. But we've already seen some corrections and so forth. But it's we're still in for probably another 50% correction yet to come, because it's been so massively inflated. Okay, number 7, increased property tax bills, increased utility bills, increased insurance rates. All of these things are continuing to go up and up and up. So yes, people all have their fixed mortgage. They're planning on that. Like I look at I got a fixed mortgage, but it's like, dude, every year my payment goes up. Why? Because of fucking property taxes, because of insurance, because of, HOA prices going up, and so forth. So when you look at utility bills specifically, I just saw this on Zero Hedge the other day and it blew my mind. There are currently 20 million households. So that's 1 out of 6 households in the United States are currently behind utility payments. So that means that, dude, they can't afford their current, already, and this stuff is just going to keep getting worse and worse and worse. And it just, the domino effect, man, it just happens. All right, so then number 8, food prices due to increase 3 to 4x over the next 12 to 24 months. And this is just from going out there and studying farmers and those that specialize in the agricultural space and food scientists. That's just the due diligence that I've been able to find. We haven't even started to really see the increases that we're going to see in the food costs due to fertilizer shortages, due to transportation costs, due to the drought. There's about 30% of farms, throughout the United States are kind of stuck in this drought where they're having to pull tons of acreage, out of crop, plus with the war taking place right now, which, you got about 30% of global grain supply and so forth. So because we're still finishing out last year's crop, we haven't even began to see the actual true pain that we are going to experience with food inflation that is yet to come. So number 9, rising energy costs. So oil, fuel, transportation. Okay, well, Josh, dude, the gas at the pump has been getting better. It's less. Well, it's still extremely high, right? So I bought a diesel truck about a year and a half ago. When I first bought it, it was $2.30 a gallon. Right now, I'm still paying $5 a gallon. Now it's $5 a gallon today. It's better than $6 a gallon I was paying 2 months ago. But one thing that we need to understand is that one of the main reasons, some of this is people are driving less, so there's some demand destruction there. But one of the main reasons is the United States government has been pulling out and releasing 1 million barrels of oil per day from their strategic petroleum reserves. The strategic petroleum reserves has it can hold 750 barrels of oil, 750 million barrels of oil. But why does that exist? Because when I'm looking at this, I'm like, okay, we've got these reserves that the government is releasing. Well, my first question is, okay, well, why do we have those reserves? What are they used for? And do they need to be replenished? Right. Well, they're there for a war. You're fighting a war. All of a sudden, our grid gets attacked, our infrastructure gets attacked. We can't get any oil. Our refineries get blown up, whatever. Well, then, bam, we have this reserve to be able to go out there and still go out there and fight that war. It's a backup measure. Right. Well, you're telling me with the increased conflict that we're experiencing, with the potential of World War III being closer than it's ever been in any of our lifetimes, with all the shit going on with Russia and China and Taiwan conflict and so forth, that we don't need to replenish those at some point. Those are going to have to be replenished. So then when those are getting replenished, now us trying to, go out there and fill up our cars and whatever, we also have the government at the same time having to fill up that 750 million barrels of reserves, and that's going to create more demand. You got more people chasing the same amount of barrels of oil that are getting pulled out of the ground each and every day. So that's going to lead to an increase and so forth. And eventually that gets depleted. Then what do we do? So this is a very temporary, at least from the due diligence and research that I've been doing, this is a very temporary problem. And I don't see any, even with the new Inflation Reduction Act bill, is like everything that I at least have been, and I could be wrong, I haven't read through the entire bill yet. These bills are intense and hard reads and freaking thick as shit. But everything that I've been able to get my eyes on so far is everything is for renewables. So it's like, okay, I don't see, money in there going to building new refineries for fossil fuels and so forth, so everything in there seems, so these are long-term fixes. Okay, so then number 10, the green energy movement. So we got this green energy movement. It's taking place. Whether you agree with it, don't agree with it, it's moving forward. It's taking place. Again, if you look at the Inflation Reduction Act, there's so much being pushed in here, with this, and that's where all the incentives are going and so forth. So we got policies being enacted, but we don't have effective plans in place to be able to help us through this transition. There's no effective transitionary plan. Like we don't have the technology or like it just, and again, this is just my 2 cents on this. And from the due diligence I do, I'm not, a renewable energy resource expert. I'm just trying to go out there and brush up and to get the only reason I dive into this stuff is to be able to know, okay, hey, where are we at? Where potentially could we be headed? What could this mean? How do I protect myself and my family from a business standpoint, a personal standpoint, to ensure that we can go out there and make it through these times and hopefully not just survive, but thrive during these times. Okay, so number 11, deglobalization. First time in any of our lifetimes, we're experiencing deglobalization. Last 70 years, we've had globalization, right? We leveraged the United States Navy to go out there and be the world police, to be able to provide safe and very inexpensive global trade, global shipping. Everybody got rich together. Those agreements and those contracts and that global social contract are done. They've been broken. They're done. It's, they're reconfiguring all the supply chain. So, okay, getting, extremely low, cheap labor from China probably isn't going to be what is going to be happening going forward. There's a lot that needs to be figured out here. This stuff is going to take time, but all of it is going to lead in at least the due diligence I've done and the way that I interpret it, to inflation in the meantime. I mean, look about so we are now increasing manufacturing and industrialization here in North America at a rate that, we've never seen before. Okay, well, you got to have workers for that. You got to have materials for all of that. Like all of this shit, is going to pull from other areas of the market and lead to, higher costs of lives and or just our day-to-day lives being more and more expensive. And maybe that solves a long-term problem, and makes it in 10, 15, 5, 10 years, 15 years, where it solves that problem. But we still got to get through these next 5, 10 year period of time and so forth. All right, so we got shrinking global demography. You got the United States, I believe India, New Zealand, that are only 3 that really have a good, decently healthy, demography. But most of the world, the baby boomers didn't have kids. So like China's got the fastest aging population right now in global history. So they don't have enough workers to fill those spots. That's going to, potentially create an increase in labor costs, and so forth. So your little iPhone, this whole thing, that took them billions of dollars to figure out, and you go get this for $1,200, which in all reality is cheap as fuck. Right? Like these might start costing us $5,000. Right? Whatever that potentially looks like. And that shrinking demography caused a lot of other, issues there too. All right, so number 13, rents going up. And over the last couple of years, if we look at rents, they went up 3 times faster than incomes. So my county right now, Maricopa County, Phoenix Metro, we are at a 13-year high with eviction filings. And I don't know if this is going to happen, but with the way things are looking, there is a probability that we could be due for a housing price correction or crash, while at the same time, simultaneously, a rental market crash or correction at the same time. And typically when you see housing markets, start to fall, like in 2008, when the market started crashing, people getting foreclosed on and so forth, rents did pretty well during that time because all those people needed a place to go. Right now, we're seeing both end up, getting in trouble right now at the same time. And that's not going to be, real estate is very hyper local. This may or may not be the case for your market. All right, number 15, an overall eradication in the middle class. So we're seeing the middle class just getting wiped out. There's no need for it. And when I say that, that's not my opinion. The people that make the decisions, and so forth globally and nationally, there's just less rating for the middle class. I mean, if you look at MIT's predictions by 2050. Only 20% of people of working age will be employable because of AI, robots, all this stuff, and we're just seeing it daily right now. Middle class being wiped out, right? The gap between the haves and have-nots just expanding at a much higher level. Well, I don't know about you guys, but most of my clientele historically until this point are in the middle class. Right. So if they're getting wiped out, how does that impact the market? How does that impact, affordability, and so forth? All right, number 16, rising taxes on everybody. I know that we're being told right now that these 87,000 new IRS agents are only to go after the wealthy, the elite, and so forth. Look, there's just not enough wealthy and elite people for a need of 87,000 new IRS agents. Let's not kid ourselves. They're going after small business owners, entrepreneurs. They're gonna go get their damn money. Right? So they're gonna go after everybody, and those struggling. They're gonna go after the middle class, lower middle class, upper middle class. So everybody's taxes are going to go up. And not just because of the IRS's, going out there and doing this. And look, I'm a by the book person. I'm one that, I look at this dude, it wasn't the CIA or wasn't the FBI that brought down Al Capone. It was the IRS, so I believe in being by the book 100%. But how many people don't operate by the book? How many landscapers, house cleaners, waitresses that already struggling, that get their, some of their cash tips, that aren't claiming those taxes. Well, all of a sudden that, that's, technically, I guess that's tax fraud. If you believe that the IRS is constitutional and not unconstitutional, which people have different beliefs on that, but it's like, this is going to put downward pressure on the take home, income of a lot of people, right? From that. Okay, number 18, consumer record low savings. So right now, the average consumer, record low savings, while at the same time having all-time high record credit card debt, all-time high record medical debt, all-time high student loan debt. And I'm guessing this $10,000 forgiveness, whatever might make some sort of a dent in that. But what is that going to do on the flip side? It's going to increase our taxes. Somebody's got to pay for that shit. As we're giving free handouts to and allowing others to be entitled to not pay off commitments that they agreed to and honored, and so forth. And I'm not saying everybody's going to take those, and it could just be political rhetoric. We'll see how this all plays out. But regardless, we have all-time high student loan debt, even though those are still in forbearance, and whatnot. But as interest rates go up, when those start being due again, boom, those are going to go up as well. All-time high mortgage debt. So number 19, record number of investor purchases during the biggest real estate peak of all time. So when you look at all these institutional investors, common thing that I hear is, oh, well, all these institutional investors bought, 25%, 1/4 of all the single family attached properties the last couple of years. They got deep pockets. No, dude, like whose money is BlackRock using? I'm not saying that they don't have deep pockets, but whose money is that? That's people's 401k money. That's like, eventually if prices start declining, if rents start declining, because they already were buying just recklessly out there. The cap rates are already so low, very quickly they could get down, pressure from their board and so forth to start liquidating that stuff, because it's like these big investors are buying this. It's not their money that they're using to buy all this property, inflate these prices and so forth, and then if they get in trouble, it doesn't matter if they lose people's 401k money. The banks still go, the Federal Reserve, like the government still bails them out, regardless of all the people that they lost their money for, and their 401ks got crushed because they malinvested that. Those people don't get bailouts, but BlackRock itself will get bailouts. Why? Because BlackRock Consulting works directly with the Treasury Department to help allocate how those bailouts and stimulus, get allocated and so forth, and whatever that may be. And I'm not trying to, sit here and say that those companies are evil and so forth. I'm just saying that, if we look at times in the past, usually during recessionary timeframes, they start liquidating a lot of their balance sheet and bad or underperforming assets and so forth. And that alone could lead to significant housing declines in prices, and so forth. All right, so then I know we talked about debt before, but when we look at debt, it's not just consumer debt. We are all-time high record government debt. You look at what's global debt right now. It's above $300 trillion, and that's on balance sheet debt. So what's the United States, on balance sheet debt is what, like, I haven't looked for a moment, but it's around 30 trillion, somewhere between 25, 30 trillion, whatever that is. But what's their off balance sheet debt? Right? There are obligations that aren't on their balance sheet. So, Medicare, Social Security, all of this stuff. Nobody knows because they don't have to tell us that, but, the best guesstimate is, around 150 trillion of off balance sheet debt for just the United States. So we're in a position where it is an impossibility to ever have this global debt ever paid back. And it just keeps growing and expanding. So what does that look like? What position does that put, everybody in? Who knows? There have been 500 fiat currencies prior to the United States dollar. They've all suffered the same fate. So you can go out there and say a little history and come up with your own conclusion on how you think that this is all going to play out long term. But then in addition to that, we got all-time high corporate debt. And then we got all-time high consumer debt. We're in the largest, biggest debt bubble of all time that we've never seen before on just magnitudes of size. Okay, so almost done here. You got new construction right now nationwide, about 10 months of inventory nationwide, and they're in a lot of trouble when you look at the entire pipeline of new construction, new build. So when we're talking about, when I talk about new construction, I'm talking about single family attached, also multi-units, put them all in the same bucket. It's close to 2 million, total units, total properties that are in that pipeline, from permits pulled to, okay, this thing is built, it's done, it's on the market, we just haven't had a buyer yet. So we're like 50-year highs of that are in that pipeline. And this is just the very beginning of it. We're just now in the starting of this softening of this insane real estate crash. This insane real estate boom that we just saw. But builders are already and again, the real estate's very hyper local here in Phoenix. We're seeing it, dude. They're offering a ton of great deals. They're putting, they understand the trouble that they're in or possibly could be in. And as months of inventory grows and as less purchase, because if you look at it, it's not just interest rates of why people aren't buying. All this other shit is adding to life just being more challenging, more expensive, for the average person. And then as this stuff starts to implode, what's the psychology look like of the average person? When they're seeing 401ks, get dropped, when they're hearing about whispers of potential layoffs, it just creates this, domino problem that can get out of control. All right, so then we got wars going on, and there's a lot of impacts from the wars, from gasoline to natural gas to heat homes, to fertilizers, to food production, to a lot of stuff that is creating a lot of global havoc. Some food scientists that I follow are talking about, hey, best case scenario, if the war stopped right now, like 1 billion people would still starve, with the issues that are taking place from, that's insane, dude. And I hope to God that is wrong. I hope to God that is, not the case at all. But there's nothing good about war that usually takes place, with that. So you got that doesn't look like it's getting any better. It just looks like it's we keep pumping money over there, and whether you think it's good, bad, or not. I'm just saying, I'm not trying to pick a side here of who's right, who's wrong. I'm just saying the longer that this takes on, the more problems that it's going to roll over to everybody. With that, then we got this possible war with China and Taiwan. Does all this lead into, you got China and Russia that are, teamed up together. They're does this lead into World War III? What does that then look like for all of us? Wars are expensive, and so forth. Number 22, rising crime rates in cities. With all the polarization, rising crime rates as food becomes more and more expensive, that is just going to continue to grow and rise. And I mean, every city, and I look at my own city, it's just like every single year, it's been for the last couple of years, it's been like 30% year-over-year increase in murder rates, and so forth. So as this continues to grow and happen, just more property crimes, more auto thefts, more all of this shit, well, then from there, at what point do people just start saying, screw it, I'm out? And if I don't have equity in my house to sell it, but I'm fearful that my family is in a bad place and I need to get out of here to a small town in a rural market, whatever, hell, I'll just mail the keys back to the bank. And I'm just saying hypothetical, decisions that people might be looking at and thinking about. But most of these big cities, dude, it is not a good situation. It is not pretty, so what does that lead to with people bailing? All right, number 23, and the last one here, you look at 66% of the first-time buyers over the last 2 years have been millennials. Of those millennials, the 66% of first-time buyers that bought in 2021, 2022, 72% regret their purchase decision. They feel that they overpaid for it. They feel that they settled for it. They had to go buy in an area that they didn't really want. They had to settle. They don't really like the property. So all of a sudden you're stuck in a home that you don't enjoy, that you don't love. And then if they feel that they got a bad end of the deal, and saw a lot of this in 2008, 2009, where people were like, hey, dude, I feel like I got a bad end of the deal. The banks won't work with me. I can't sell this house now. The banks aren't willing to work with me. Screw it. I'll just mail the keys back. How many of if all of a sudden they're like, if I look at my market, it took from 2009. So kind of at the bottom of the market from 2009, took until 2019. It took 12 years for the average sales price to come back. It took 12 years to recover from the damage that crash did. Are people going to ride that out? Maybe it's not 12 years. Maybe it's not that severe. But if they're in a house in an area, in a location that they don't like, they feel like they got in a raw end of the deal, whatever it may be, whatever their psychology may be at that point, are they going to ride it out? It's like, dude, if I'm in a house that I love, in an area that I like, and I've lost 100, 200 grand on my house, and I got to ride it out for 10, 15 years, to rebuild that back up. Okay, that's one thing. But dude, if you're in a house that you can't, like you got massive buyer's remorse, and then it just eats at you every day, like what percentage of those are just gonna be like, fuck it, screw it, I'm out. Okay, so those are the 23 reasons. The other thing I want to share with you guys here, and we'll wrap up here shortly, but I want to show you the data that I pay attention to here. So if I look at this, because I said earlier of like when it comes to with all those things, I'm not doing this as getting you guys' fear point. This isn't about trying to spook you or scare you. I'm just a guy that deals in reality. Okay, let me deal in realities of where things are at, where things potentially could go. How do I pivot and best position myself in my real estate business? I'm in the trenches each and every day like you guys. How do I position myself to go out there and navigate with where this market is going and so forth? So, first thing is just mentally to understand that there's no such thing as a good market. There's no such thing as a bad market. The real estate market's always good for somebody. You need to identify whom the market is good for, and then go out there and pivot, focus your attention and marketing efforts and so forth to whom the market is good for. So that's number one. So like get this mindset out of, oh, dude, market's going to be tough. I got to drop out. No, if you're paying attention and you pivot and shift, like there's always going to be massive opportunity. Yeah, you got to commit. You got to be willing to put in the work. You got to go out there and do those things. But anybody that's listening to this video, especially if you've been listening this long, I already know that you're committed, so you're good to go from there. Okay, so the next thing is paying attention to data. So here is, this is just a simple spreadsheet. And you can see here, I've been keeping this my whole entire career. So, this is, 17 years worth of data. And the reason why I didn't go back to, where our MLS keeps data to back in 2020 is because 2005 was the start of kind of our boom market, which was the biggest boom that we had seen prior to 2020 and 2021, even more specifically 2021. So we had never seen, at least with the MLS data that we have from our MLS system, that low of inventory data. So I just look at this, right? So then from here, what am I tracking? The biggest thing I'm tracking is inventory rates. So when I look at inventory rates, absorption rate, months of inventory, it's all the same thing. They're just used interchangeably. This is real estate is subject to supply and demand, just like any other product, right? So I know that 3 months or less of inventory, of housing inventory absorption rate on the market is going to be a seller's market. That means that there are more buyers than there is product. So we got demand is greater than supply. That drives prices up, right? Well, then when demand and supply are equal, or kind of neutral, that's just going to be, kind of your neutral, low appreciation market. You're kind of healthy, again, neutral market that is maybe 1 to 2% usually above, inflation. That's kind of what your average 3 to 4% year over year, maybe that it appreciates, and so forth. Well, then, so 3.1 months to 4.9 months, I know is going to be kind of neutral territory. Okay, 5 months and beyond. Okay, I know that we are now getting into a buyer's market, meaning that there is much more supply than there is demand. Buyers are now in control. So if I have 100 water bottles, but I only got 10 people that want to buy those, well, I got to probably price them aggressively because there's an abundance of them. Well, if I have 10 water bottles and I have 100 people that want to buy them, I can start driving up the prices of those. It's the same shit, right? So I start looking at this, and we start to see, okay, well, so I got monthly inventory rates. I got the amount of new listings month over month. So how many new listings hit the market that month? Here was the amount of sales for that month. Here was the average sold price for that month. Here was the median sold price, average list price, median list price, average days on the market, total active listings that were available during that time for single family attached, and then the amount of pending homes. The main thing I'm paying attention to is this right here, though, these inventory rates, right? So we can see here and look at, okay, well, May 2005, this peaked. Let me actually make this a little bit bigger so you guys can maybe see it better on your screen. So we had a low of 1.53 months of inventory, so a month and a half worth of inventory. right? So, and again, a lot of multiple offers driving prices up. It was just, you could see, average prices from, that month to the next month went up about 17 grand, so, I mean, this was insane territory, not quite as insane as my market was in 2010 or 2020, 21, but was the most insane that we had seen and had seen up into 2020, 2021. So then when I start looking at this, okay, well, each month I can see it slowly gaining, it's slowly climbing up here. So as we get into 2005, so the market peaked really in May of 2005. When I say that, I'm talking about from a supply and demand standpoint. There's a little bit of lag with pricing and so forth. I'm just speaking from a supply and demand standpoint. But then from there, we had 30 straight months of slow, gradual incline of inventory rate before we entered massive demand destruction territory in 2008. When I say demand destruction, meaning that's when it just kind of fell off a cliff and shit just went haywire. Well, by the time we hit that was 13 months of inventory. But you can see, look at this. I mean, with this gradual climb for 30 months, the common thing I heard from so many people, now back here, 2005, 2006, early 2007, even though when we're seeing this trend go up and up and up and up, eventually knowing supply and demand and how economics works and demand destruction works, like knowing that, okay, like it's just a matter of time before this shit implodes. But everybody was, the market, there's no way the market's going to crash. Okay, well, like, look, dude, we're in buyer territory. It's just a matter of time before prices go down, and this keeps going up and up and up. They just make it that much more severe as far as how prices go down. So when people tell me like, oh, the market crashed, 2008, the market crashed, nobody could see it coming. I'm like, how could you not? I get if you weren't in real estate, but it's really like you had 30 months of data showing that this is where we were going, this is where we were heading, this is what's taking place. So right now, if I fast forward to 2020 or 2022, again, like first quarter of this year, we're staying pretty consistent, pretty steady. Well, now we start to see, okay, now it's upticking. Right. You saw interest rates increase here, stayed pretty steady, well, then boom, by May, okay, now we're starting to see an increase. Then June, we're seeing an increase. July and August is going to be well above 3 months. So I can start to track this and pay attention to this and see, okay, well, at this point, like I know once we start seeing about 7 months of inventory, 6-7 months of inventory, that's what we start to see, more short sales historically coming back. We start to see 8-9 months of inventory. That's where I know I'm prepped to start, getting into and getting my foreclosure relationships back and getting that going and focusing on that. So when people tell me, oh, we're nothing like 2008, I'm like, I'm not saying that. Right now, what I'm saying and seeing is that we are very similar to kind of last quarter of 2005. Again, we're starting to see like we're about right here, about September 2005. And I'm just watching this trend versus that time, seeing how it goes. It's accelerating faster than it did, back then. So we'll see, how much more this accelerates. But the cool thing about this is at any given time, then historically, you can go look at, so if you're like, okay, well, we're gaining two months of inventory every single month or 2 weeks of inventory every single month. So, okay, within 8 months, I know we're going to be at 6 months of inventory. And then if this continues in 18 months, we'll be at 12 months of inventory or whatever. Well, then historically, you should be able to go back in your market and see what makeup and what type of business were you doing there. So during the great financial crisis and leading up to that, what point did you start seeing short sales in your market? What point did you start seeing foreclosures? What point did they become a big percentage of the business? What percentage of the business were they? And I'm not saying that always history repeats itself, but it absolutely definitely rhymes. And there might be new things that we see, in new markets. But for the most part, these trends, tend to follow from historic trends. So this is what I'm paying attention to. So for me, it's like, dude, again, I don't want to see, I'm mixed on with the market crash, right? I think we need a severe market crash, just to make it affordable for the American dream still to take place and so forth, but I hate seeing people go through that pain, and all of that. So, but with that, like, dude, to me, it's like, I look at this when people are, oh, is it going to crash? I'm like, dude, it doesn't matter. I'm planning for it to crash. I just went through 23 reasons as to why. Those aren't all the reasons that I believe it's going to. There's a lot of other things taking place as well, but There's a lot of the big main ones, that can put us into a bad position. I mean, easily put, the average person today is in a much, much, much worse position than they were in 2006, than they were in 2007, and they were at the start of 2008. So I'm looking, okay, the average person is in a much worse position than before the last housing crash, which was the worst housing crash in recorded history. They're in a much worse position before the start of it. And we also have the biggest debt bubble of all time, the biggest, all asset class bubble of all time. I'm like, well, how can't it be worse? Okay, well, maybe if we switch to MMT and we just start printing endless amounts of money, okay, maybe if our monetary system, completely dramatically change, okay, there's a lot of manipulation, there's a lot of things that could take place that could make that wrong. And again, so I'm just a hope for the best, plan for the worst. I'm not, playing with this, but for me, at the end of the day, it's like, it doesn't need to matter. Right? Like I'm paying attention. What are the moves that I need to make? Based on this, where the current opportunity is biggest right now, based on these trend lines, where are we heading? So I know what to focus on now, and I know what to start to build and focus to, and for the next 6 months, the next 12 months, and so forth. So I can pivot accordingly, because it's going to be what it's going to be. I can't control it. You can't control it. So why am I going to get all caught up in it? To me, it's going to be what it's going to be. So anyway, hope you guys find this helpful. Keep crushing it, keep kicking ass, and I will see you next time. Peace.